Good day. This is the last part of the three-part lecture on sole proprietorship, partnership, and private corporation. As part of meeting the objectives of this topic, today's session will discuss the doctrine of piercing the veil of corporate fiction and three legal cases applying the lessons learned from our previous discussions on the different forms of business entities in the Philippines. So again, here are the objectives. So, what is the piercing the veil of corporate fiction or the alter ego doctrine? It is basic in corporation law that a corporation is a juridical entity vested with a legal personality separate and distinct from those acting for and on its behalf, and in general from the people comprising it. So, the key word is the corporation is a separate and distinct person from the owners. That's what you need to remember in understanding piercing the veil of corporate fiction. So the corporate veil should not and cannot be pierced unless it is clearly established that the separate and distinct personality of the corporation was used to justify a wrong, protect fraud, or perpetrate a deception. So piercing the veil may be allowed only if the following elements concur. Number one, control. Not mere stock control, but complete domination, not only of finances, but of policy and business practice in respect to the transaction attack. So parang uh, i- it should appear that the corporate entity, as to the transaction in question, had at that time no separate existence of its own. And then such control must have been used by the defendant to commit a fraud or a wrong, to perpetrate the violation of a statutory or other positive legal duty, or a dishonest and an unjust act in contravention of plaintiff's legal right. And the last one is that the said control and breach of duty must have proximately caused the injury or unjust loss complained of. So take note in Concept Builders Incorporation versus NLRC, the court enumerated the possible probative factors uh, of identity which could justify the application of the doctrine of piercing the corporate veil. So these are one, stock ownership by one or common ownership or both corporations. So parang yung stock owners of the two corporations are the same. Identity of directors and officers are also the same for the two corporations, and the manner of keeping corporate books and records, and also methods of conducting the business. So to better understand the doctrine, let us take a look at how it was applied in the case of Commissioner of Customs versus Oil Link International Corporation, a case decided in 2014. So U Corporation imported oil products. Later, U Corp was incorporated for the primary purpose of manufacturing, importing, exporting, buying, and selling oil and gas. And then U Corporation and O Corporation had the same board of directors, and U Corporation was 100% owned by O Corporation was 100% owned by U Corporation. So the district collector of Port of Manila formally demanded that U Corporation pay the taxes and duties of its oil imports that had arrived. Subsequently, the Customs Commissioner directed that U Corporation pay the amount of 100,000, representing U Corporation's special duties, VAT, and excise taxes that it had failed to pay at the time of the release of the 17 oil shipments that had arrived. Then in May 2020, U Corporation conveyed to the Customs Commissioner their willingness to pay only 60,000, of which the initial amount of 30,000 would be taken from the collectibles of O Corporation from the National Power Corporation, and the balance to be paid in monthly installments over a period of 3 years to be secured with corresponding post-dated checks and its future available tax credits. So in August 2020, the Customs Commissioner made a final demand for the total liability of 120,000 upon U Corporation and O Corporation. Can the Commissioner of Customs lawfully pierce the veil of corporate fiction in order to treat O Corporation as the mere alter ego of U Corporation? So, court, what was the decision of the court? So, the court said there was no ground to pierce the veil of corporate existence. So, according to them, a corporation, upon coming into existence, is invested by law with personality separate and distinct from those of the persons composing it, as well as from any other legal entity to which it may be related. So they reiterated the ruling in the case of Philippine National Bank versus Retrato Group Incorporation and outlined the circumstances that are useful in determining whether a subsidiary is a mere instrumentality or of a parent corporation. So number one, as we've discussed, so the elements of when when the court may pierce the veil of corporate pierce the veil of when the court may pierce the veil of corporate fiction. Number one, control, not mere majority or complete control, but complete domination, not only of finances but of policy and business practice in respect to the transaction in question. So that transaction must at that time, it's clear that between the two corporations there is no separate existence. Then such control must have been used by the defendant to commit fraud or wrong, to perpetrate the violation of a statutory or other positive legal duty, or dishonest and unjust act in contravention of plaintiff's legal rights, and then the aforesaid control and breach of duty must proximately cause the injury or the unjust loss being complained of here in the case of the Commissioner of Customs. So the court also said that applying the instrumentality or alter ego doctrine, the courts are concerned with reality, not form, and with how the corporation operated and the individual defendant's relationship to the operation. So, consequently, in the absence of any one of the foregoing elements, this authorizes the piercing of the corporate veil. So the doctrine of piercing the corporate veil has no application in this case because the Commissioner of Custom did not establish that O Corporation had been set up to avoid the payment of taxes or duties or for purposes that would defeat public convenience or justify wrong or protect fraud, defend crime, or confuse legitimate legal or judicial issues. So it is also noteworthy, according to them, that from the outset, the Commissioner of Customs sought to collect the deficiency taxes and duties from U Corp, and that it was only later on that the Commissioner of Customs sent the demand letter to both the corporations. So that alone was revealing because the failure of the Commissioner of Customs to pursue the remedies against all corporation from the outset manifested that it be that its belated pursuit of O Corporation was only an afterthought. So what we can learn from this ruling is that the application of doctrine of piercing the corporate veil should be done with caution. So the court was mindful uh, on how it should be applied. So the three elements discussed: control, and then the use of that control to commit fraud, and then yun, and then the existence of breach of duty which causes injury or unjust loss. Those three must be present. Then here is a case applying the law on partnership. On behalf of Q Corporation, Maria and Jane entered into a contract to purchase various ingredients for coffee drinks from X Incorporation. They claimed that they were engaged in a business venture with Juan, who was not a signatory to the agreement. The total price of the ingredients amounted to 670,000. Packaging items worth 100,000 were also sold to Q Corporation by X Incorporation. Maria, Jane, and Juan agreed that they would divide the profit from selling mixed coffee drinks and borrowed some money to start their operation. Later, the buyers failed to pay for the ingredients and the packaging. Hence, X Incorporation filed a collection suit against Maria, Jane, and Juan. The suit was brought against the three in their capacity as general partners on the allegation that Q Corporation was a non existent corporation, as shown by a certification from the Securities and Exchange Commission or SEC. So Juan argued that no partnership agreement registered before the SEC would make them partners. So the question is this contention of Juan valid? Does partnership exist? Can Juan be considered a limited partner only? So the fact that there appears to be no record in the SEC of a public instrument embodying the partnership agreement, according to Article 1772 of the Civil Code, did not cause the nullification of the partnership. Maria, Jane, and Juan had decided to engage in a coffee shop business, which they started by buying the ingredients and packaging. Their intention to divide the profit among themselves and the borrowing of money to finance their operation fell under the term common fund. That's under Article 1767 of the Civil Code. The contribution of such fund need not be in cash or fixed assets. It could be intangible like credit or industry. That the parties agreed that any loss or profit from the sale and operation of a coffee shop would be divided equally among them also shows that they had indeed formed a partnership. Moreover, the partnership extended not only to the purchase of ingredients but also to that of packaging. So both were obviously acquired in furtherance of their business. It would have been inconceivable uh, for Juan to involve himself so much in buying ingredients alone and not the packaging, as they both go together in a coffee shop business. So in this case, is Juan a limited partner? The answer is no. A partnership transacting business with third person is indisputably presumed to be a general partnership. Further, the essential requisites in forming a limited partnership again are number one, a certificate of limited partnership, and that number two, the certificate should have been registered with SEC, which is absent in this case. Okay, then we go to the third case. Let us take a look on the sample case applying the law on corporation. XYZ Corporation is a publicly listed company engaged in the manufacturing of consumer electronics. The corporation has been facing financial difficulties for the past 2 years due to a sharp decline in demand for its products and increased competition from foreign manufacturers. As a result, the corporation's financial health has deteriorated and it is struggling to pay its creditors and meet its obligations. In an effort to address its financial troubles, the board of directors of XYZ Corporation proposed a resolution for voluntary dissolution during a special shareholders meeting. The resolution was approved by a majority vote of the board and confirmed by the affirmative vote of the stockholders, representing more than two-thirds of the outstanding capital stock. The corporation then submitted a verified petition for dissolution to the Securities and Exchange Commission in accordance with the Corporation Code of the Philippines. However, a group of minority shareholders who opposed the dissolution filed a complaint with the SEC, arguing that the dissolution resolution was invalid. They contend that the board did not adequately explore other alternatives to save the corporation and that this dissolution was not in the best interest of all shareholders. So the question is the contention of the minority shareholder regarding the validity of the dissolution resolution valid? So, how would we rule in this case? The contention of the minority shareholders regarding the validity of the dissolution resolution should be assessed based on the provisions of the Corporation Code of the Philippines and corporate governance principles. So, under the Corporation Code, the resolution for voluntary dissolution of a corporation can be approved by the board and confirmed by the affirmative vote of stockholders representing at least two-thirds of the outstanding capital stock. In this case, the board of directors proposed the dissolution resolution and it was approved by majority vote of the board and confirmed by the affirmative vote of stockholders representing more than two-thirds of the outstanding capital stock. So they actually met the requirement of the corporation code on the number of votes. From a legal perspective, this process appears to comply with the statutory requirements for voluntary dissolution. However, the contention of the minority shareholders raises concerns about corporate governance and fiduciary duties. Directors and officers have a duty to act in the corporation's and its shareholders' best interest if the minority shareholders can demonstrate the board did not adequately explore other reasonable alternatives to save the corporation, or that there was a conflict of interest, self dealing, or other misconduct involved in the decision making process. They may have valid grounds to challenge the validity of the dissolution. So ultimately, in this particular case, the validity of the dissolution resolution may depend on a thorough examination of the facts, including the board's decision making process and whether it acted in furtherance of the corporation or in furtherance of their self interest. Okay. So now we go to five set of cases. So in this exercise learning application, the succeeding slides will show five cases. Each group should analyze the case and submit a written case analysis. So, in analyzing cases, follow this guide. Read the case problem carefully, identify the legal issues, evaluate the facts of the case in relation to the identified legal issues, determine which facts are favorable to each party and which are relevant to the legal analysis. Then you explain the relevant legal principles or rules that apply and state your conclusion as to how the legal issue should be resolved. And we will discuss in class the answer to each case. So that ends our discussion on the laws on sole proprietorship, partnership, and corporation. Thank you.